All of us know that the main and strongest currency in the world right now is the dollar. Many countries and companies rely upon the US dollar to make their stock exchanges, buy resources, import and export valuables each day. Yet this hasn't always been the case. Before the US dollar, there was, known by many and desired by all, gold. Today, we'll be exploring the history of the gold standard, how it shaped the world as it is today, and how it left its throne to the US dollar. If you're looking for more information about economics and money, make sure to hit that subscribe button and ring that notification bell to be notified of further videos about what's going on in the world. The gold standard is a monetary system in which the value of a country's currency or paper money is closely tied to the value of gold. Countries agreed to convert paper currency into a predetermined quantity of gold under the gold standard. A country that adheres to the gold standard establishes a fixed gold price and buys and sells gold at that price. The value of the currency is determined by that set price. If the United States establishes the price of gold at $500 per ounce, the dollar is worth 1 out of 100 of an ounce of gold. The gold standard, as the name implies, is a monetary system in which the value of a currency is determined by gold. A fiat system, on the other hand, is a monetary system in which currency value is not based on any physical commodity and is instead permitted to fluctuate dynamically against other currencies on the foreign exchange markets. The word fiat comes from the Latin word fieri, which means arbitrary deed or decision. The value of fiat currencies is ultimately predicated on the fact that they are designed as legal currency by government etiquette, in keeping with their etymology. International commerce was conducted on the basis of what became known as the classical gold standard in the decades leading up to the First World War. Physical gold was used to settle commerce between nations in this arrangement. Gold was accumulated by countries with trade surpluses as payment for their exports. Those countries with trade deficits, on the other hand, saw their gold reserves fall as gold flowed out as payment for imports. A visit to any of the world's earliest sacred places will illustrate how gold was employed purely for worship at the beginning of this fixation. The most common application of gold nowadays is in the production of jewelry. For the first time about 700 BC, gold was turned into coins, improving its use as a monetary unit. Previously, while settling deals, gold had to be weighed and tested for purity. Gold coins were not a perfect answer, because clipping these somewhat uneven coins to gather enough gold that could be melted down into bullion was a frequent activity for centuries. The Great Recoinage in England established a technique in 1696 that mechanized coin manufacture and eliminated clipping. Because it could not constantly rely on further supplies from the earth, gold supply was limited to deflation, commerce, looting, and debasement. In the 15th century, America had its first big gold rush. In the 16th century, Spain's capture of New World treasures increased Europe's gold supply by 5 times. In the 19th century, gold rushes occurred in the Americas, Australia, and South Africa. The use of debt instruments produced by private parties was used to introduce paper money to Europe in the 16th century. While gold coins and bullion remained to dominate Europe's monetary system, paper money did not take hold until the 18th century. The battle between paper money and gold would lead to the establishment of a gold standard. A monetary system based on the gold standard is one in which paper currency is fully convertible into a set amount of gold. In other words, gold backs the value of money in such a monetary system. As the introduction of paper money caused certain complications, the creation and formalization of the gold standard occurred between 1696 and 1812. In 1789, the United States Constitution gave Congress sole authority to mint money and to regulate its value. The creation of a single national currency allowed for the standardization of a monetary system that had previously relied on circulating foreign coins, chiefly silver, to function. In 1792, a bimetallic standard was introduced because silver is more abundant than gold. While the official silver-to-gold parity ratio of 15:1 exactly represented the market ratio at the time. Due to Gresham's law, the value of silver rapidly dropped after 1793, forcing gold out of circulation. The problem would not be resolved until the Coinage Act of 1834, and then only after much political wrangling. Hard money supporters argued for a ratio that would reintroduce gold coins to circulation, not necessarily to drive out silver, but to push out Bank of the United States small denomination paper notes. A 16:1 ratio was set, which clearly overpriced gold and inverted the circumstance, putting the United States on a de facto gold standard. England was the first country to formally adopt a gold standard in 1821. The rapid expansion in global trade and production over the century resulted in huge gold discoveries, which enabled the gold standard to survive long into the following century. Because gold was used to resolve all trade imbalances between nations, governments had a strong incentive to store gold for more difficult times. Those stocks are still on the ground today. Following Germany's acceptance of the gold standard in 1871, the worldwide gold standard was born. By 1900, the gold standard had been adopted by the vast majority of developed countries. The United States, however, was one of the last countries to join. Throughout the 19th century, a powerful silver lobby kept gold from becoming the exclusive monetary standard in the United States. The gold standard was at its peak from 1871 to 1914. The globe was under near-ideal political conditions throughout this time. Governments worked well together to keep the system running. But with the onset of the Great War in 1914, everything changed. Political alliances shifted after World War I, international debts rose, and government finances suffered. The gold standard was not stopped throughout the war, but it was in limbo, displaying its incapacity to withstand both good and terrible times. This led to a loss of faith in the gold standard, exacerbating the economy's problems. It became more clear that the world's global economy required a more flexible foundation. At the same time, there was a strong yearning among nations to return to the halcyon days of the gold standard. The British pound sterling and the US dollar became the worldwide reserve currencies as gold supplies continued to slip behind the expansion of the global economy. Smaller countries began to hold these currencies in preference to gold. As a result, gold became more concentrated in the hands of a few big nations. The 1929 stock market crisis was only one of the world's post-war problems. The pound and the French franc were terribly mismatched against other currencies. Germany was still suffocated by war debts and repatriations. Commodities prices were plummeting, and banks were overextended. Many nations attempted to maintain their gold reserves by boosting interest rates to attract investors to hold their deposits instead of converting them to gold. The global economy has only become worse as a result of these rising interest rates. The gold standard in England was suspended in 1931, leaving only the United States and France with significant gold holdings. The U.S. government then revalued gold from $20.67 per ounce to $35 per ounce in 1934, boosting the amount of paper money required to purchase 1 ounce to support the country's economy. As other countries were able to convert their existing gold stockpiles into additional U.S. dollars, the dollar's value plummeted. Because of the greater gold price, more gold was converted into U.S. dollars, essentially giving the U.S. a monopoly on the gold market. Gold output surged to the point that, by 1939, there was enough in the globe to replace all the world's currencies. The top Western governments convened as World War II came to a conclusion to construct the Bretton Woods Agreement, which would serve as the underpinning for global currency markets until 1971. All national currencies were evaluated in reference to the U.S. dollar, which became the main reserve currency under the Bretton Woods regime. The dollar was then exchanged for gold at a set rate of $35 per ounce. The gold standard continued to operate in the global financial system, although in a more indirect fashion. As a result of the agreement, gold and the US dollar have developed an unusual connection throughout time. In the long run, a falling dollar usually indicates higher gold prices. This is not always true in the near term, and the link might be shaky at best, as the 1-year daily chart below shows. Notice how the correlation indicator changes from a significant negative correlation to a positive correlation and back again in the graph below. However, because the connection is still skewed toward the inverse, negative in the correlation research, gold tends to fall when the dollar increases. The United States owned 75% of the world's monetary gold at the conclusion of World War II, and the dollar was really the only currency still backed solely by gold. As the world reconstructed itself after World War II, however, the United States gold reserves steadily declined as money poured to war-torn countries and the country's own strong need for imports. The gold standard was suffocated by the high inflationary environment of the late 1960s. In 1968, the United States and a number of European countries formed a gold pool that stopped selling gold on the London market, enabling the market to determine the price of gold on its own. Only central banks were allowed to trade with the United States at $35 per ounce from 1968 to 1971. The market price of gold might be kept in line with the official parity rate by making a pool of gold reserves available. This relieved the burden on member countries to sustain their export-led growth objectives by appreciating their currencies. However, as foreign countries' competitiveness grew, so did the monetization of debt to fund social programs and the Vietnam War, putting a strain on America's balance of payments, with the surplus turning into a deficit in 1959 and mounting fears that other nations might begin redeeming their dollar-denominated investments for gold. Senator John F. Kennedy declared in the latter phases of his presidential campaign that if elected, he would not try to weaken the dollar. The gold pool was disbanded in 1968 because member countries were unwilling to fully cooperate in keeping the market price of gold at the price in the United States. Belgium and the Netherlands exchanged dollars for gold in the years after, with Germany and France expressing similar intentions. Britain requested payment in gold in August 1971, pressing Nixon's hand and formally shutting the gold market. It was official by 1976 that the dollar would no longer be measured by gold, therefore ending any appearance of a gold standard. Nixon ended the direct convertibility of U.S. currencies into gold in August 1971. The international currency market, which had been more reliant on the dollar since the Bretton Woods Agreement was enacted, lost its official relationship to gold with this move. The United States dollar, and by extension the global financial system it supported, entered the era of fiat money. While gold has piqued humanity's interest for over 5,000 years, it hasn't always served as the foundation of the monetary system. From 1871 to 1914, a truly international gold standard existed for less than 50 years, during a period of global peace and prosperity that corresponded with a huge increase in gold supply. The gold standard was a symptom of this prosperity and peace, not the cause. Though a modified version of the gold standard lasted until 1971, the death of the gold standard began decades earlier with the development of paper money, a more flexible mechanism for our complicated financial world. Gold's price is now dedicated by demand for the metal, and while it is no longer utilized as a standard, it still has a significant role to play. For countries and central banks, gold is a valuable financial asset. It's also used by banks as a strategy to protect themselves against government loans and as a gauge of economic health. Gold, like the euro, yen, or US dollar, should be seen as a currency in a free market economy. Gold has a long-standing inverse relationship with the US dollar, and this relationship will continue in the future. With market volatility, it's usual to hear talk of establishing a new gold standard, but this isn't a foolproof system. When compared to paper currency in the economy, treating gold as a currency and exchanging it as such can reduce risks, but it must be understood that gold is forward-looking. Waiting until tragedy strikes may not provide an edge if the market has already moved to a price that represents the state of the economy. If you enjoyed the video and learned something from it, please consider liking and subscribing. It would mean a lot to keep these informative videos coming your way. And if you want to be notified when a new video drops, be sure to ring that bell.